This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set for a cautious open, with Wall Street closed for Thanksgiving. Tech leading gains in Europe on signs that US curbs on chip equipment sales to China may be less harsh than first feared. Brazil's real hits an all-time low on stock slump as $12 billion in spending cuts fail to convince investors worried about the budget deficit. And tech giants bracing for the fallout as Australia passes a contentious law banning under-16s from social media. And let's get the latest, of course. One of the biggest surprises has really been coming from Korea this week, and we're getting more indications of how that domestic economy is faring at the moment. This is the picture when it comes to industrial production numbers. We are seeing just that output rising 6.3% year on year. That is a big beat on the estimate of just over 2% there. Industrial output on a month-on-month basis, though, largely unchanged. The expectation was a gain of 0.2%. We're also seeing that cyclical leading index falling just a little bit there as well. But this, of course, as we had that surprise move from the BOK, as we see that sort of growing global concern over growth headwinds.
Yeah, the first back-to-back rate cut since the global financial crisis in 2008. But really what we'll be watching today also, Heidi, the commodity space. We saw gold also edging higher. We had inflation data out of the U.S. more in line with estimates. Are we going to get that Fed rate cut in December is the key question, right? Not to mention that we had some safe haven flows into gold given the rising tensions around Ukraine, with Vladimir Putin threatening ballistic missile strikes on Kyiv as strategic decision points in the capital. And we'll be watching oil prices. Of course, OPEC Plus also delaying their meeting until next week, and the expectation is for a delay in production.
We are also watching some of the growing anxiety, right, over fiscal as well as political situations in Europe. And this is quite a milestone and not really one to be proud of. I guess French 10-year borrowing costs are matching that of Greece for the first time on record. This is just the latest move in a week that's been marked by mounting anxiety and concerns over the fate of the French Prime Minister Michel Barnier's government. So the rate on the 10-year French notes are generally considered among the safest across the euro area, briefly rising to 3.03% before pairing that move. Same as comparable Greek bonds, of course, which was an asset and a country that was at the heart of the European sovereign debt crisis. So it is just an indication that investors, Shery, are increasingly worried that France could struggle to pass a budget for next year. A lot of the political implications as well, particularly when it comes to the demands coming from the far-right National Rally Party.
And what was interesting was that despite the fact that we saw that pressure on French assets, we actually had European stocks gaining ground overnight, and that to do with Bloomberg report that the U.S. curbs on chip equipment sales to China might not be as strict as originally expected. Take a look at how U.S. futures are trading, because, of course, trading was closed with the U.S. Thanksgiving holiday. So overall, we had pretty thin trading. When it came to the dollar, also pretty steady, but we're headed towards breaking that 8 weeks of gains that we saw on the greenback. Take a look at how Asian assets are setting up, because the Japanese yen weakened slightly overnight, but this is after gaining ground against the dollar about 2% already this week. We have a ton of data coming from Japan, so watch out for that. We have retail sales, jobs, not to mention, of course, Tokyo CPI later in the day. Nikkei futures up more than 1% at the moment, as we're watching, of course, the offshore yuan also at that 725 level. But Heidi, of course, very key what's happening in Australia and the RBA as well.
Yeah, and we did have a little bit of, a sort of incremental move, perhaps against expectations when it comes to inflation, but that doesn't seem to have really changed the intention of the RBA Governor, Michelle Bullock. And it's quite interesting because we still heard really that reiteration that inflation remains too high to consider a rate cut in the near term. The policy settings are sort of less restrictive compared to other central banks, and they've really been trying to strike this balance of trying to engineer a soft landing, bringing down prices, preserve these job gains as well. So she talks about the word sustainably being really key here because it recognises that they need to look through temporary factors impacting the headline inflation rate. So to that end, we've got some fresh calls when it comes to ANZ as well, expecting in terms of some of the expectations for both the RBA and the RBNZ, and looking that to feed through to the mood of this session as well. We've had a couple of pretty strong days of gains for Australian equities. While next guest says the Fed might need to cut rates more than the market now anticipates if a soft landing is to be achieved. Let's bring in from Hong Kong, Poole, who's a CIO at Ascalon Capital. Isaac, always great to have you with us. And I do wonder if you can sort of give a bit more nuance to this call, because on the face of it, seeing the Fed cut more, it seems a little bit sort of counter what the markets are pricing in at the moment, particularly with the expectations of some of the tax and tariff and broader fiscal policy from President-elect Trump.
Yeah, I think that it is a little different to what people are expecting, but it really focuses in on the consumer. And we are seeing some difficulty in the consumer sector. The lower-end consumers are spending less and higher-end consumers are trading down. But markets are willing to look through that because the labour market has been fairly resilient. But the catalyst for this shift could be a little bit of a trend higher in unemployment, which has been trending higher for some time, a little bit of economic weakness in the near term. And that could be enough to really cause a bit of an inflection point in the US economy, where if a soft landing is to be achieved, the Fed will simply have to be cutting more in 2025 to achieve that.
So there's a couple of the sort of most acute risks that you see, and one of them is repricing in equity markets and potential returns, and the other is in high yield.
That's right. I think the equity market is particularly important because we have valuations that look really quite stretched relative to history, but also relative to earnings growth and expected earnings growth. And the challenge here is, if you look at those valuations, they're not just pricing in resilience in the US economy anymore. They're really pricing in a re-acceleration of growth. And that re-acceleration of growth is not going to happen if inflation stays sticky. It's not going to happen if the Fed doesn't cut by more than expected. And so that is a real challenge, I think, to putting more money to work in equities at the moment. And similarly for high yield or sub-investment grade credit, spreads are really tight relative to history. Now, there's parts of that sub-investment grade market that are faring better and parts that are faring worse, but on average, those spreads are really tight. And it's just not the case that investors are being compensated for taking on that risk right now.
And really, that idea that we are going to see re-acceleration of growth in the U.S. is selling yields higher, U.S. dollar higher, but at the same time is also what's on the other side of the trade. I mean, we are seeing significant weakness in the euro, given expectations that Europe will not be doing that well, that we will see ECB rate cuts. And of course, we have these gyrations today when it comes to French bonds. What do you make of the implications of this dynamic globally and the divergence and the implications for the markets?
Yeah, I mean, the Eurozone has been struggling for some time, and France has become a bit of a poster child for that, with yields pushing higher. I mean, we're not back at Eurozone crisis levels at all. These are a move higher, reflecting some of the risks that are poking up through the political situation over there and the fiscal challenges that France faces. But more broadly, Eurozone growth is slowing. And when you look at the US, where growth also looks to be stalling perhaps, we have the risk of tariffs being introduced that could put inflation up. Possibly in the near term, the Fed holds rates a little steadier before being forced to cut more aggressively next year. It's a difficult environment, and yet the volatility that you see across equity markets suggests that markets are really okay with these risks. And that suggests maybe just a little bit of complacency starting to build up for investors across various risk assets. And complacency of itself can cause a little bit of a correction, particularly if you get a data point or two that go against that re-acceleration narrative.
And we have seen, of course, the implications of that pressure on economic growth, especially in Korea, with that surprise rate cut by the Bank of Korea. We already had a rate cut by the RBNZ this week as well. How are you going to be playing sort of the divergence that we're seeing in monetary policy, especially now with, as Haidi mentioned earlier in the show, the RBA seeming to be a little bit of an outlier when it comes to that easing cycle? Not to mention the BOJ, I'm sorry. I mean, we cannot forget the Bank of Japan, the big outlier, right?
It's still likely to hike, possibly before the end of this year. The RBA is certainly not looking to cut anytime soon. And this is reflective of diverging monetary policy, but also inflationary outcomes for various parts of the world. If you look at the RBA, the economy has been very weak for some time on a per capita basis. It's been in recession for many quarters, and yet inflation has just not got back towards the RBA's target, and that has allowed the RBA, I think, to deliver a really clear narrative that they are not going to cut in the near term. Of course, things can change quite quickly, and I think in the first part of 2025, if we do see the unemployment rate continue to tick higher, and it has been trending higher, the RBA is going to probably be forced to cut as well. And I think importantly here, we're probably looking at a situation where we could get a 0.5 percentage point cut as the first cut from the RBA. That could be as soon as April in 2025. And if the economy continues to slow or remain weak, we could see a real series of rate cuts in Australia through next year.
Isaac Poole, always good to have you with us, CIO at Ascalon Capital here with his views on the broader markets. And this, as we continue to see gyrations around emerging market currencies as well. We had seen this big jump in the Mexican peso, gaining more than 1% at one point against the U.S. dollar after President-elect Trump said that he had productive conversations with Mexico's President Claudia Sheinbaum. And really a different story for the Brazilian real, which fell to a record low after the government's plan to cut spending disappointed. Brazil stocks also slumping in the biggest single-day drop in more than a year. Let's cross to Rio de Janeiro, and our markets reporter Leda Alvin joins us from there. Leda, I mean, what's going on in Brazil? Is it the expectation that inflation will not be able to be tamed given sort of what's perceived as a lack of fiscal restraint?
Well, thank you for having me. As you mentioned, it was a very ugly day for Brazilian assets today. And that was all because the government announced its highly anticipated spending cut package, which was about $12 billion of spending cuts through 2026, which includes limits to minimum salary growth and higher taxes for incomes above 50,000 reais. But the big problem, and what caught markets by surprise, is that with that measure to announce the spending cuts, the government also announced a measure to exempt wages of up to 5,000 reais from income tax. The concern is that that measure will water down the fiscal impact of the spending cut package and will also impulsionate even more the inflation expectations, which are already above the target, and it could make it harder the job of the central bank, which is already hiking rates.
Just how big is the budget deficit, and can we see Lula stick to his populist agenda?
The growing deficit has been a major issue for investors for many years now. But since Lula took office in 2022, early 2023, it's been a major concern because he has a very populist agendas, and he's always pushing for a lot of social programs, and he likes to commit to his campaign promises over government spending to social issues and to tackle poverty. And that is a little bit of a tricky situation for markets because they are demanding a little bit of austerity from Lula because the budget deficit is growing at high speed. And there are concerns that it will make harder the job for the central bank to continue to hike rates, to control the rising inflation expectations, and it just adds more uncertainty. The real is selling off. So, all of that worsens the outlook for Brazilian assets.
Yeah, so are we going to continue to see the underperformance, especially as you said, we might see more central bank rate hikes?
Yeah, the underperformance, according to many analysts that we spoke today, is set to continue, especially until we see more measures from the government on the spending side. The market wants to see more commitment over its fiscal targets. Just in April, Lula's administration tweaked a key budget target, which paved the way for higher spending. So this continues disappointments that investors have been seeing over and over again, just causes more distrust. And so now it's more of action than promises. They want to see those measures come into action before things get out of control.
Our Brazil markets reporter Leda Alvam there. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to energy prices at the moment. This is how WTI is trading. We have seen that delay when it comes to the OPEC Plus meeting that was supposed to happen this Sunday. They've pushed it out to December 5th. This meeting is discussing whether to delay a planned increase in oil production potentially for several months. There are, of course, ongoing concerns about oversupply, but really it's that balance between prolonging these curbs into next year or potentially risking a global glut. And we have seen crude futures down about 16% since early July. So that pushing back of the OPEC Plus meeting suggesting that perhaps there's a great deal more discussion to be seen. The other thing we're watching, of course, is gold in reaction to some of these increasing geopolitical threats. Russian President Putin's threat of ballistic missile strikes on Ukraine is one that's boosting haven demand. Bloomberg's Michael Heath joins us now for more on this new threat. And this, as we see, the barrage of attacks really continue. Is this in response to Ukraine using more of these Western weapons?
Well, yeah, it's an interesting contradiction because on one hand he says, well, yes, we may target decision-making centres with this intermediate ballistic missile, and that's in response to the the Western okaying for Ukraine to fire into Russian territory. But on the other hand, he said those Ukrainian strikes haven't done any damage as such, so it's a little bit unusual. I think there's a degree of sabre rattling, of bluster in talk of using this missile because they probably don't have many of them, and they're not the most accurate things, and they really are meant to be delivered, to deliver nuclear weapons. So it's probably a bit of a waste of Russia's resources. Now, that's never stopped Russia in the past, but I think to some extent he just wants to keep this issue bubbling along, and in a way it's sort of the idea is that, again, to sort of say to the Trump camp, to give them some ammunition that, again, the Biden administration is miscalculated and they've provoked Russia, when in fact it's just, Russia's brought all these North Korean troops over here. That was the starting point of all of this. But it's a traditional Russian thing just to flood the zone with various narratives until, people who are observing it don't really know where it started and where it ended, kind of thing. So, yeah, look, more bluster there. The worrying part, though, is that Russia did conduct a massive strike on Ukraine's electricity and its energy sector. Winter is coming, winter starts next week, and it's extremely cold in that part of the world. And the idea of not having power during that time is really, really got to be unpleasant for people who live in Ukraine. And it's real psychological warfare from Russia. It's a very cruel regime in Moscow.
And not surprising, we are seeing the U.S. really urging for more manpower in this fight against Russia as well, right? Not just advanced weapons coming from Ukraine.
Yeah, that's right, Shery. I mean, Ukraine, when they got into the war, they had this. They made a strategic move that they weren't going to mobilise the young, I think it's 18 to 25-year-olds from memory, because they wanted a younger generation to be able to pick up the pieces once this war was over. So they've had sort of an older army there, people who've sort of had combat experience, perhaps have served in the Soviet military, before independence, that sort of thing, because they wanted to protect that younger cohort to be the next leadership of the country. But after 3 years of war, and even though Russia's lost 2-3 times more men than Ukraine, it's obviously got 2-3 times more population as well. So the pressure is mounting on Ukraine. To date, President Zelensky seems to be pushing back. He doesn't want to do that. He just sees it as so important that Ukraine has a proper leadership. It's a nascent democratic system there, and they want that generation that's been raised in democracy to come in and take over and push the country forward. So that's going to be an interesting one to watch.
Bloomberg's Michael Heath there. More ahead on the Asia trade. This is Bloomberg.
Doesn't actually make social media safer for young people. And that's the devastating thing about this. Because we know that there are families who are struggling with this. We know there are young people who are struggling with their body image, their connection with their community, their peers. Young people who are finding themselves addicted to these dangerous algorithms. But this bill doesn't do any of that.
Australian Greens Senator Sarah Hanson-Young there speaking in opposition to a social media ban for under 16-year-olds that was voted into law late last night in Canberra. Bloomberg's Paul Allen joins us now. So this ban has plenty of critics, clearly, but overwhelming support as well, including from voters and including really both sides of the aisle.
Absolutely. It's interesting how the division's fallen over this, because we heard the Greens there opposing this social media ban, and in fact the entire crossbench in the Senate opposed this. But who supports it? The government and the opposition. We had two opposition senators, though, cross the floor to oppose it. So a really interesting breakup of the division in Parliament in terms of support and opponents. But you're quite right, there's overwhelming public support here. 77% of voters supported this ban. Parents want action on this is the short story here, and there is votes in this kind of a move. Youth suicide rates are up. It's the leading cause of death now among 10 to 17-year-olds in Queensland, for example. And obviously there's a social media bullying online dimension to a lot of those. But the question is, as Sarah Hanson-Young said there, how's it going to work? It's not parents that are responsible for enforcing this, but the onus is on social media companies, with penalties of up to $32 million for failing. And now other countries are looking at this as well, without the nuts and bolts of actually figuring out how to enforce it.
And those companies must not be too happy.
No, they're not. And Elon Musk, the CEO of X, has been one of the most vocal critics. He says this is a backdoor way to control internet access for all Australians. X more broadly says it's got serious concerns over the lawfulness of this bill. TikTok says it's rushed, unworkable, unresolved concerns, and Meta says it overlooks the practical realities of age assurance technology, as well as just failing to make young people safe. Even UNICEF is concerned that this is just going to push young people to even darker, less regulated places online. And there's exemptions too. WhatsApp, for example, will be exempt from this. Online gaming, other messaging apps, and obviously things like bullying, grooming, those occur on those platforms as well. So still many questions over how this is going to work, but it doesn't come into force for another 12 months, so there is time perhaps to iron out some of these questions.
Paul Allen here in Sydney. We have more ahead on the Asia trade. This is Bloomberg.
And we have breaking news right now out of Japan. We are getting the Tokyo CPI numbers when it comes to core CPI, excluding fresh food, year-on-year growth of 2.2% for the month of November, accelerating from the previous month and also coming above economist consensus. And this, of course, as we had some utility prices being rising in the past month, given that the government cut some energy subsidies, not to mention a weaker yen. We are also seeing the headline number for Tokyo CPI gains of 2.6% for the month of November. Again, an acceleration, and of course, with the Tokyo CPI being an indication of future nationwide prices. The jobless rate right now also coming in at 2.5%, which is slightly higher than the previous month. We had fallen in the month of September to the lowest since January. So we're a little bit higher on the jobless rate for the month of October. But we are seeing the labor market tightening even more because the job to applicant ratio is coming in at 1.25, 125 jobs available offered for every 100 applicants. So we are seeing a little bit of an improvement when it comes to those jobs offered for the month of October. Let's digest all of these numbers with Bloomberg senior editor Brian Fowler. Brian, I guess with the numbers looking a little bit more, should I say, positive or encouraging, are we expecting a move from the Bank of Japan, I guess is the question now.
Well, Shery, we knew that going into this, that the move would likely come either in December or in January. The market economists were just a little over 50% looking at December. So we knew December is going to be a live event in any case. And I think today's data coming above consensus, as you pointed out, of course, above the BOJ's target once again, would probably shift the case for a hike in December. Ueda has already said that there's a ton of things, data and information to sift through ahead of that decision, and I would expect to see him come to Parliament at some point to testify before the Budget Committee, and at that point he'll be asked about monetary policy and inflation, and I would expect to see him give us a pretty clear hint one way or the other. So it's going to be very exciting to watch.
Yeah, because you don't want to surprise the markets like you did back in July, right? Parliament very busy right now. I mean, we are expecting the Prime Minister to speak. There's a budget issue right now. What are we expecting?
Yes, it's kind of a peak of news for Japan today and in the next couple of weeks. So we expect the Cabinet to approve the extra budget. That's big news. It's a little bit bigger than last year's extra budget. It's got all sorts of steps to sort of help people cope with rising prices, and Prime Minister will probably, if he knows what he's doing, he's probably going to talk that up and tell people what a great package it's going to be for them to improve their livelihoods, and he'll probably make the most of it in order to score some political points.
Will that be easy? Because is there a fair amount of concern that if the Bank of Japan hikes too rapidly, or that comes sort of, too much and potentially derails what these budget negotiations are going to be? We know that some of the opposition members are sort of against moving too quickly, too soon on the monetary policy side.
Yeah, Heidi, that's a key question. And we did ask the tax chief of the DPP just in the last few days, and he came out and he said that while he doesn't want to see the BOJ hike rates at any kind of a rapid pace, he also seems to have confidence that the BOJ won't do that, that it will conduct policy with a view to achieving price stability but not derailing the economic recovery. And I think, with policy still well below the natural rate, the BOJ can continue to move toward neutral without jeopardizing the economic outlook.
Bloomberg senior editor Brian Fowler in Tokyo. And another economy that we're watching, of course, here in Australia. And let's take a look at how we're faring when it comes to... It has been a couple of days of pretty robust gains across Australian equities. And we're coming off that now. Still, these stocks are trading pretty close to those record highs over the past few sessions. We're also watching the Aussie dollar at 65.05 at the moment. So seeing a little bit of a strengthening there as we had these comments from the RBA Governor, Michelle Bullock, on the RBA's policy direction. Let's get some more now with our economy reporter, Swati Pandey. So again, this reiteration of what it means to look at sustainable inflation, right? She's really sticking to her guns despite perhaps some more encouraging, travel in the right direction with the last inflation read.
That's right. When we read the speech last night, we thought that there was an amplification of language there, because she had said previously that inflation is too high, and she has said previously that we don't need to cut rates immediately, but for her to put together the two sentences and say that inflation is too high for us to consider rate cuts, like it just felt like an amplification of language. And she tried to double that down in the Q&A as well when she spoke about how strong the labor market was, and she compared Australia's labor market with other countries, developed countries where there have been higher unemployment rate or a slowdown in employment growth. We have not seen that in Australia. Our unemployment rate is still at 4.1%, and that, she says, gives us the confidence that we are on that narrow path that the RBA keeps talking about, and that interest rates can remain at 4.35% for God knows when.
Well, and there's plenty of political pressure, right? Particularly if we are getting, at some point over the next few months, an election being called. With the passing of the RBA reforms, has anything meaningfully changed? Because, you know, that component is there for the Treasurer to use, and we know that the Greens, for example, is actually, you know, pushing the government to use it. Doesn't seem likely.
No, it's very unlikely that the government will use that to override the RBA's decision. What is, I think, important right now is that under the dual structure, which probably will take effect from March, we will have a new set of board members, and the RBA will then probably will be able to give us unattributable votes. And that is what the markets are really interested in. If that is a decision that Michelle Bullock will have to take, but the RBA had said that they will release or publish unattributable votes if we have the dual structure. So that is something that will be interesting. Then we will kind of get a better flavor of what's happening in the board meeting, whether the decision is actually consensus or whether kind of it's more of a thin debate. And the other thing is the board members will go out and speak publicly, which does not happen right now. So we only hear from the governor and the deputy governor on monetary policy, and under the new structure, then the board members will be speaking as well. Again, that is a decision that Michelle Bullock will take sometime in March. But these are the two important things that will come out from this passage of bill.
The other thing that, of course, is going to be front and centre next year is how the global economy reacts, right? Particularly when it comes to what expectations there are from the incoming Trump administration, what they do with China, and Australia is such a big kind of proxy to that.
Yes, Michelle was asked about this as well yesterday, and they have been speaking a little bit about the impact from the new Trump administration, the impact from tariffs. And right now they say that it's really hard to say what the impact on Australia will be. Yesterday she said that there is a chance that the moves are deflationary because it may lead to a global growth slowdown. But on the other hand, higher tariffs and higher US government spending are inflationary. So it's kind of like pulling in all directions, the forces. And so it is a bit difficult for them at this point to gauge what the impact will be. But China is Australia's #1 trading partner. And if there is an impact on China's economy, it does tend to affect us as well. So they are keeping a close eye for sure.
Bloomberg's economy reporter Swani Pandey here in Sydney. More ahead on the Asia trade. This is Bloomberg.
The U.S. retail sector is hoping for a bonanza in coming days with the annual holiday sales fest that begins with Black Friday and runs through the weekend to Cyber Monday. This year, it comes with U.S. consumer confidence at a 16-month high on optimism about the labor market, stocks, and inflation. That's according to a survey by the Conference Board. Their chief economist, Dana Peterson, joins us now. Dana, great to have you with us. So are we expecting to see more signs about the health of the American consumer this shopping season?
Yes, we do expect that. Our own survey of consumer confidence suggests that households have money and they're willing to spend it. They're looking to buy toys. They're looking to buy trips on vacations. They're just really excited about the holiday season.
How confident are you that this optimism can be sustained into the next administration when the threat of tariffs looms large?
Well, consumers, as long as they're still working, they have almost infinite capacity to spend. And certainly we saw that over the last couple of years as consumers continued to work. They saw the wages rising. And as long as that continues to happen, consumers will spend. However, if we do have another trade war with elevated tariffs, that will cause inflation and consumers may pull back on spending. So that really is certainly a downside risk to the household sector for next year.
It's not just tariffs, right? It's a variety of potential for other policies. If the mass deportations, for example, take place, that's going to have a meaningful impact, right, when it comes to the labour market. Are all the kind of risks to inflation and price pressures for households pointed to the upside going into the next few years?
We think yes. Certainly as consumers many of them are retiring, and they're also certainly seeing that yes, many of them are retiring, and also they're seeing that the labor market is going to be shrinking in terms of workers. That means higher wages, and that's going to feed through to inflation. Certainly, we have elevated housing costs that are still making inflation sticky. And also we see insurance costs rising, certainly for cars, for healthcare, and also for homes. So all those things suggest that we may have upward pressures on inflation, which means that the Fed will have to keep interest rates probably higher than what we're used to.
And all of this, of course, leaves the Fed in a really, not just the Fed, but, as we've been seeing, confounding global central banks, really, right? We've got the inflation gauge, the favoured inflation gauge picking up. Does this kind of suggest that caution is the right approach here? How reactive can the Fed be on policy when it comes to potentially very quick changes in fiscal policy?
Well, the Fed can't react ahead of time to fiscal policy. Chair Powell has even said, look, we have to see what those policies are before we can even incorporate them into our forecasts. And so the Fed is really going to have to be reactive and understand that whatever comes out of policy, that it will affect the economy. And if some of those things are inflationary, it means the Fed may slow its pace of cutting interest rates because they want to get inflation back to a 2% target and sustain it there.
And yet investors and the broader markets right now thinking that even if you don't get those very fast Fed rate cuts, that there's another Trump put in the markets because he'll be really opening the taps when it comes to fiscal spending. So we have seen this incredible rally in U.S. stocks. How much of that does it really benefit the American public? Because I know that during the first administration of Donald Trump, he kept really referring to how your 401k is doing better. But at the end of the day, not a lot of Americans actually have 401ks.
That's true. Most Americans don't actually have savings, let alone 401k plans. The thing is that I think much of the focus of the incoming administration will be around taxes. Again, we have this really big tax cliff in 2026. And so Congress plus the White House must figure out what to do about all the tax provisions that are going to be expiring. Most of those tax provisions include lower taxes for consumers, certainly for individual tax cuts, also for pass-through businesses or small businesses. There's also the child tax credit. All those things may go away. And so Congress will need to deal with that. And also there's a big focus on actually cutting spending, not doing more government spending. And so with all of that, we could see some pretty big disruptions to the economy and certainly a smaller contribution from government GDP growth to the economy next year.
What does it mean for the U.S. dollar? And is a stronger U.S. dollar, what we've seen in the last 2 months or so, better for the U.S. economy or worse?
Well, typically, we do like to have a fairly strong U.S. dollar. It helps exporters. But if there's a significant rise in the U.S. dollar, then that causes inflation abroad. And it also makes U.S. exports much more expensive. And so in the end, if you have too much of a good thing, it really does harm the economy. And certainly if we do see more additional tariffs on goods coming to the U.S., we will see the U.S. dollar rally. And that could also weaken our stance for our exporters.
Dana, Really great to have you with us, and we appreciate you joining us on this holiday. Dana Peterson, Chief Economist at the Conference Board. Let's get you the latest when it comes to some of the corporate headlines we're following. Saudi-backed Live Golf is said to be weighing a potential deal with Europe's DP World Tour. The talks may see the two competitions merge, creating a shared schedule and allowing golfers to play in both. Live Golf started as a rival to the PGA Tour, luring top players and sparking animosity with the existing tours. Renault is said to be going on a hiring spree in China, a market where it doesn't even sell cars. Sources say the French automaker has hired 200 people in Shanghai, mostly hardware engineers working on development of its Twingo EV. We're told it plans to hire software engineers as well. A Renault spokesman says the firm is there to learn. China is one of the few markets where EVs are selling well. Tokyo Gas says it will look at a variety of options to help unlock the value of its real estate, including selling some assets. Japan's biggest utility gas provider will also look at ways to use its properties better. Activist investor Elliott Management reported a 5% stake in Tokyo Gas last week and wants the firm to sell down holdings not related to its core energy business.
Not only real estate, but also other assets may not necessarily have high efficiency. So we will carefully review these areas and decide whether to sell them if necessary or to make good use of them through various financial methods. We will consider on a case-by-case basis what kind of approach is best.
K-pop superstars New Jeans have officially declared they plan to part ways with Korea's biggest music company, Hybe, citing breach of contract. The move comes after a months-long revolt by the group against their label, which is an affiliate of Hybe. The performers told a news conference in Seoul that they may no longer be able to use the name New Jeans. The group generated about 5% of Hybe's sales last year. More ahead on the Asia trade. This is Bloomberg.
Breaking news out of Japan, we are getting the industrial production numbers. The preliminary figures for October are coming in at growth of 3% month on month, which is lower than economists had expected. It's an acceleration from the previous month, though, and on a year-on-year basis, we're seeing growth of 1.6%. We're also following retail sales data, a year-on-year growth of 1.6%. This is disappointing to the downside on expectations of 2% growth, but it's still an acceleration from the previous month. That's the year-on-year number. Month-on-month is also acceleration of 0.1%, and really coming up from that contraction territory in the previous month. So, Haidi, we have more just data coming out of Japan. Of course, we had jobs and Tokyo CPI numbers earlier in the hour as well. So we'll be watching the market moves, with the Japanese yen having strengthened after Tokyo November core CPI surprise to the upside.
And, you know, when we talk about Japan's economy, that sort of looming a dread in the subtext is always the demographic challenge, right? And demographic transition has been such a defining feature of many significant shifts in economic history. But Bloomberg opinion columnist Daniel Moss is arguing that concerns over falling fertility, ageing populations may actually be overblown. And Dan joins us now with his latest column. So, of course, China is also looking down the barrel of this. Are you saying that an empty planet isn't worth stressing about? What is this about a demographic dividend rather than the challenge?
Okay, so there are certainly challenges and there's a good deal of adaptation to be done. You know, one of my main points is that this demographic transition that we're going through right now, and this is certainly not limited to Japan or China, though Japan was the original poster child for crisis. This does require adjustments, but it's some of the language and some of the doom-mongering that sort of underlies a lot of this commentary is overblown. You know, if you look back through the past couple of hundred years, demographic change, and by that we mean smaller families, has been associated with major hinge points in economic history. And these have almost all worked out in the direction of greater prosperity. You know, a lot of the policies that we're seeing rolled out by countries, there's almost a wistfulness. Oh, if only we could turn the fertility tide around. You know, the ship has probably sailed. These are good policies to have regardless, but we need to stop looking back through this rose-tinted glasses where families were massive and, you know, think about adjustments. And, you know, part of the way we think about this and the changes that are required, look, if you think about it, we've changed the way we talk about race, we've changed the way we talk about gender. Why not change the way we talk about this demographic transition? You know, maybe we should stop saying
we do
senior
understand
moments.
what you mean
we
by...
wouldn't say that about any other...
by not really fear-mongering when it comes to the demographic changes. But there are issues related to fertility levels just getting lower and lower and an aging society for the broader economy.
Yes, certainly. We need to contend with what role we want technology to play, not just in the workplace, but in caring for people and in schools. We need to think about policies related to immigration. Not easy stuff. Some of these are hot-button terms. But, you know, again, we also need to think about what's happening in the labour force as a reality. You know, I mean, who really stops working at 65 these days, right? Do you know anyone who stops at 65? You know, yes, this is likely to result in, all things being equal, a slower pace of growth. But it doesn't have to be catastrophic. And by the way, it's happening. It's happening. Right. And there were sound reasons why governments introduced policies aimed at reducing the size of families. Very sound reasons.
Bloomberg opinion columnist Daniel Moss there with the latest on those fertility levels and the concern around the world as we await the market opens in Seoul and Tokyo. Of course, we'll be watching the currency markets with the Japanese yen strengthening after that Tokyo core CPI surprised to the upside. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. No clear direction as U.S. markets were closed on Thanksgiving holiday, but we are watching the commodity space, Haidi, as we have seen Russia's threats to strike with ballistic missiles the Ukrainian capital of Kyiv.
Yeah, that's really playing into that haven demand when it comes to the likes of gold, right? We're also watching for some fluctuations when it comes to oil. OPEC Plus pushing back that meeting that was supposed to happen this weekend. Clearly some consternation as to the path ahead when it comes to, you know, how they deal with the risk of a supply glut. But Shery, at the same time, a lot of consternation for central banks, right? We're hearing from the RBA that inflation on a sustainable level still too persistently high to cut.
Yeah, we're watching the Bank of Japan as well because we got Tokyo core CPI surprising to the upside and the Japanese yen strengthening off the back of that around that 151 level against the U.S. dollar. And of course, this afternoon, also in Japan, we're watching for that approval of the extra budget. We are expecting Prime Minister Ishiba to speak in Parliament. We got plenty of data to digest. The Nikkei is down 0.3% as we speak. We had not only the Tokyo CPI, which is sort of an indication of nationwide prices later on, but also October jobs data. We saw October labor market really tightening even more from the month of September. We also had industrial production and retail sales a little bit more mixed in that front. But take a look at how the Kospi is coming online because we're also trying to digest, of course, the first back-to-back rate cuts from the Bank of Korea since the global financial crisis. We had the Korean won weakening off the back of that right now, holding holding at that 13.94 level, and we're seeing some downside pressure for the Kospi as well. We're watching entertainment stocks, Haidi, as we just heard that New Jeans parted ways with Korea's biggest music company, Kyiv.
Shery, we're also taking a look at what we're watching when it comes to a little bit of a pullback for Australian risk assets at the moment. Certainly when it comes to Australian stocks, we have seen a couple of very strong sessions this week, really sending again Aussie stocks to those record highs. But at the moment, we're seeing a little bit of profit taking, about 0.5% lower there, trading on the ASX this Friday session. We are also, of course, really seeing the impact on the currency, a little bit of strengthening for the Aussie dollar, given the remarks that we had from Michelle Bullock on just the strength of inflation and the idea of sort of sustainable inflation, putting the two together of inflation still being too high from a sustainable point of view to consider rate cuts in the near term. So really being seen as a doubling down of that rhetoric that the RBA is still pretty far and dislocated from where a lot of central banks are at the moment in their easing cycles. We are also, of course, sort of broadly watching to see what the next leg of this US rally will be, Shery, right, given we are sort of getting a little bit of a weakness in that Trump trade.
Our next guest sees a reduced chance of the U.S. equity rally broadening out beyond Wall Street. Let's bring in Julia Wang, Executive Director and Global Market Strategist at JPMorgan Private Bank. Julia, good to have you with us. Does this at least mean that we could continue to see some strength for U.S. markets, at least as Haidi alluded to the Trump trade continuing?
Hi, good morning. Thanks for having me on the show. So, first of all, I think we've been overweight the U.S. market for a while, so that has not changed. We continue to like the U.S. market going into the next 12 months. So that is the part of the investment thesis that has not necessarily changed. And within the U.S. market, we do think that technology continues to be, from a 12-month basis, the sector that we like the most, although we are still adding other sectors into the rotation as well. But I think the part of the puzzle that I think is somewhat changed in the recent months is more to do with the rest of the world from two perspectives. One is the valuation gap and how much that can close vis-a-vis the U.S. market. And I think that with the increased tariff risk and the uncertainty, that does mean that maybe less of a rapid catch-up or less of a chance of a significant convergence in terms of valuation. From an earnings perspective, it's less clear. We do think that some markets outside of U.S. can continue to have reasonably good growth on the earnings side next year. Japan is still a market that we like. And even for markets beyond Japan, even for China, for example, some sectors could still have reasonably good earnings growth. So that part where, not saying outright that there'll be less earnings growth. It's just that from a market perspective, how much you're rewarded for that earning growth may be reduced given the uncertainty. So it's still a U.S. outperformance thesis, but I think that the part that's changed a little bit is more really the rest of the world.
If we continue to see a stronger U.S. dollar, will that have an impact on Asian equity markets?
I think so. I think equity always plays into an investment thesis when it comes to outside of U.S. market, and I think that broadly you would expect that we talked about the Fed rate cut earlier. You guys talking about it. We still think the Fed can cut, but broadly I think the mix of policies coming out of the President-elect administration probably will generally sustain our dollar at a somewhat elevated level. It might not shoot up further, but it will just sustain at a reasonably strong level. That could broadly still keep Asian currency somewhat on the back foot. But we do think that some type of divergence is also likely to happen within Asia. Japan, for example, you can see the dollar yen's coming down quite a bit because the market probably has underpriced how much the Fed will actually cut in the next 12 months at least. And Japan's domestic economy continues to be quite strong. Whereas on the other hand, markets like Korea are already giving a nod to the external uncertainty. So I think you can still see some currency divergence playing out within this backdrop of broadly resilient dollar. That can mean some still opportunities for investors in the Asia region as well, even in this backdrop.
So you're neutral on China at the moment. What would need to happen to kind of give you more conviction in either direction?
So I think the biggest driver for growth in this market probably will be on the earnings side. And so far it's been a mixed picture. But I think if we see domestic demand, the property market, consumer sentiment stabilizing in the next 3 months or 6 months, that could mean earnings may surprise a little bit on the upside vis-a-vis fairly bearish expectation at this moment. So that could be one area where we see a market getting a bit of a boost in the next 6 to 12 months. Another area is really more on the policy side. I think that given it looks like they're going to be fairly reactive when it comes to responding to whatever tariff comes through from the U.S. side. And the domestic reflation from the policy side is also quite measured or paced in some sense. So the cumulative impact on growth may play out more in the second half of the year, at least how we're thinking about it. There's still a lot of uncertainty, but we think it could play out more in the second half of the year. So that could be something also to watch out for, just the cumulative impact of all these incremental policy support. I think it's broadly quite hard to have a prescriptive view on what exactly will happen, but I do think that watching out for earning growth on the back of domestic demand stabilization and watching for those policy support coming through in the data maybe in the second half.
Where are you looking to for downside protection at this point, if you are?
So, I mean, there are a lot of uncertainties for investors to hedge for. So you kind of have to know what you are hedging for at this point. And I think that one area we're watching out for is just, the volatility or bumpiness around this base case. And a lot of that will be, I think, from a somewhat growth negative. If you think about the headline risk, tariffs, just the uncertainty with regard to sequencing of different policies. So they could all play out to be somewhat growth negative. So we do think that core fixed income is still a good hedge in that environment. The bond equity correlation's already been much more stable. That's already in and of itself a really good reason to add to fixed income. And then yields are, I think, a fair value at this point. They could be higher, but this is a fair value outside of a fiscal really big panic type of situation. So I think broadly adding to fixed income will definitely help investors weather the volatility in the market next year. Even though we are broadly positive on equities, we think that fixed income is definitely something investors should consider adding at this point.
All right, Julia Wang, Executive Director and Global Market Strategist at JPMorgan Private Bank. Good to have you with us. Take a look at how Tokyo Gas is trading at the moment in the Asian session. We are seeing some upside after we heard from Tokyo Gas that they will be considering a variety of measures to unlock the value of their real estate assets, including potentially selling some that are not efficiently used. This, of course, after we heard that Elliott Investment Management had a 5% stake in this company, which is Japan's biggest utility gas provider. Elliott wants the company to sell down their multi-billion-dollar portfolio that has little apparent overlap with their core energy business. We're also watching another stock in South Korea, especially around entertainment stocks. HYBE right now losing more than 6% because K-pop superstars New Jeans parted ways with this biggest music company in South Korea. Their affiliate has ended that exclusive contract with New Jeans. New Jeans claiming that there was a breach of contract. So we'll be watching that broader entertainment sector in South Korea today. More ahead on the Asia trade. This is Bloomberg. The Japanese yen headed towards that 150 level against the U.S. dollar. We continue to see that strength, especially after it had weakened. It has strengthened already more than about 2% against the U.S. dollar this week. So we had the core Tokyo CPI numbers coming in stronger than expected. So markets now thinking perhaps the Bank of Japan will have some leeway to hike rates come December. We will be watching those comments by Governor Ueda when he speaks in Parliament soon. But in the meantime, we are seeing the Japanese yen strengthening, especially after we had that economic data as well. Retail sales, not to mention industrial production out of Japan. So we're digesting all of that here. But we're also watching China, which has abruptly suspended a senior official from the nation's top military body led by President Xi Jinping. It's the latest escalation of a corruption investigation that's rattling the leadership of the People's Liberation Army. Let's bring in our China correspondent, Min Lo in Hong Kong. Min, so what do we know at this point about that investigation?
Yeah, the PLA is a very opaque body, so we never really know the true extent of these investigations. But officially from the Defense Ministry, we understand that Miao Hua is being suspended. He is the top political commissar. He's part of the Central Military Commission, which is this 6-man body, the apex decision-making body of the People's Liberation Army, headed by President Xi himself. There are 2 vice chairs under President Xi, and Miao Hua is the 5th ranking officer in charge of overseeing political loyalty. So you can imagine his position needs to be held by someone who is redder than red. He is being charged with violating party discipline, which is often code word for either engaging in corruption or some sort of political disloyalty. And this comes, of course, just about 1 day after the Financial Times reported that the Defense Minister Dong Jun is also under investigation for potential corruption. This is according to U.S. officials. But Beijing has denied that. The foreign ministry is saying that the reporting is, quote, 捕风捉影. That means clutching at the shadows and catching the wind. It's an idiom that means that you're basically chasing rumors and fabrication.
What are the implications of this for Xi's ambitions and the PLA?
Yeah, certainly it does show how widespread the corruption purge is so far, because more than a dozen senior military officials had already been unseated since China embarked on this corruption probe, looking into the purchase of hardware going as far back as 2017. And it comes just months after 2 former defense ministers were also denounced from the party on corruption and disciplinary charges as well. And it does also raise some questions around the selection process of these officials, especially with Miao Hua. He is seen as someone who has been personally promoted by President Xi. So there are questions around whether Xi has misplaced his trust in some of his subordinates here. There are also questions around, of course, combat readiness as well, because China is trying to project its power in the South China Sea, in the Taiwan Strait, the 2 biggest flashpoints with the U.S. right now. And this sort of purge is giving a sense of turmoil in the military, and also the extent of it being so widespread. Some analysts say it is perhaps even beyond the anticipation of President Xi, showing that this corruption allegations is really reaching to the very upper echelons, the elites of the PLA here.
Bloomberg's China correspondent Min Lo there. Let's take a look across commodities and watching WTI. We're sort of still stuck in that pretty tight range that we've been since about October, as investors continue to try and work out what's going on with OPEC Plus. They've pushed back that weekend meeting by about 4 days, and really that juggle between whether to proceed with returning supplies to the market, the delayed gathering, or prolonging those curbs into 2025. We have seen a weekly loss of about 3% on track when it comes to crude futures. That ceasefire between Israel and Hezbollah, lower trading volumes at play as well. The other geopolitical conflict we're watching, of course, is Russia and Ukraine, and Putin now saying that Russia may strike Kyiv with new ballistic missiles. Let's bring in Michael Heath for the latest on this, and this is a new threat as we see the barrage of attacks on power facilities as well. Is this sort of in retaliation to the use of Western missiles?
Yeah, I mean, it's real tit for tat, Heidi, because the beginning of this was North Korea transferring troops to Russia to serve on the Ukrainian front, which then prompted President Biden to lift a long-term bar on Ukraine being able to fire these Western weapons onto Russian territory, which they'd seen as, as fairly provocative. Obviously, when you're dealing with a nuclear state, you have to be, pretty cautious in how you do things. But the Russians have sort of wiped out that early part of it and see that as, and are just saying that the West has amped up what it's doing, so they intend to respond. And so, yes, this intermediate missile, it doesn't seem to be a new missile. It just seems to be sort of some additions on an older one. That they're going to use this as well and potentially target decision-making centres. They probably don't have many of these missiles, so it would be a bit of a surprise thing to do. But a lot of this sort of comes around the sabre rattling and the rhetoric to do with the nuclear issue, which is always Russia's trump card, and spooking everybody, just to try to keep the West, cautious in what it allows Ukraine to do.
In the meantime, what's the economic situation for Russia? Because there's been comments about obviously the big moves that we see in the currency. Putin says it's not of any concern. I think that's. He's over his 25 years in power. He's said that fairly regularly, and it's come through for him reasonably well because of the oil price. But the ruble's dropped about 10%, and there's a lot of talk now that they're going to need to raise interest rates potentially to 25%. They're about 21% now. So what we're seeing, and this is the real issue with the Trump administration, and it's talk about bringing peace within a day and that sort of thing, is there has been mentions by various people in the Trump camp that they'd be prepared to lift some of the sanctions on Russia, which would probably really be to the West's detriment, because Russia's had this boost from the military. All of its old Soviet-era military factories have been revived in the countryside, and people getting paid well. But this is a real short-term boost. Its economy in general is in a really tricky situation, particularly over the medium term, and its elite absolutely hate these sanctions. They can't deal with Western banks, they can't travel as they want, that sort of thing, and there's not a lot of point in being very, very wealthy and above the law and that sort of thing if you can't exploit it. So these sanctions, despite them not crippling Russia as people thought it would initially, they are still having a very significant effect. And in terms of keeping the Russian regime on the back foot, lifting them would be a real win for Russia, perhaps more than even bringing the war to a close.
Not surprising, President Putin seems to be pretty satisfied with Trump having won the election. He's now calling him intelligent and experienced.
Yeah, look, Vladimir Putin is, he's a KGB agent. He's all about, stroking people's ego when it suits him, and or try to hit them where it hurts when it doesn't. And obviously, Trump is very, very susceptible to flattery, and Trump has, as has been reported many times, he has quite a fascination with these autocratic sort of leaders, Putin in particular. So kind words from Putin are always going to be well received by Donald Trump. The issue then is that Trump has a reasonably experienced and quite interesting foreign policy team, reasonably hawkish as well. So the interesting part will be they know what they're doing probably. Well, you'd be pretty confident they know what they're doing in terms of negotiating with Russia, what that regime is, etc. It's mainly Trump, how much he intervenes in this sort of thing, and Putin would like, I think, Trump to intervene heavily because, to get a peace settlement, because as long as the war comes to an end and there's, it's just sort of a frozen conflict, and there's no chance of Ukraine getting any Western guarantees or any, path into NATO, and the prospect of, as I mentioned, of sanctions being lifted, they're all wins for Russia, because Russia can always come back and have another go at Ukraine at some other time. But it has been stretched now. It's lost a lot of men. It's used a lot of that Soviet weaponry that had been built up over decades, and it really hasn't got very far considering all of its advantages there. So whatever Trump does in terms of bringing this conflict to a close, but more importantly, lifting some sanctions, will be a big win for Putin.
Well, there's Michael Heath there joining us with the latest on those geopolitical tensions. The markets are watching really closely. Take a look at how European futures are trading at the moment. We are seeing some downside, a little bit of pressure on the Euro Stoxx 50 futures. This after, in fact, European stocks rose overnight for the first time in 3 sessions. And this was with technology stocks leading those gains. Bloomberg reporting that U.S. restrictions on those chip equipment sales to China may not be as strict as initially expected. But of course, Haidi, we continue to see that pressure on French assets, with the 10-year yield matching Greece's for the first time ever on concerns around their budget.
It's really extraordinary, right? When you take a look at comparable Greek yields, of course, we're talking there about an economy and a country that was once at the heart of the European sovereign debt crisis. So really something that would have been inconceivable previously for 10-year rates on the French notes, given they're traditionally considered among the safest in the euro area. But it just kind of marks investor anxiety, which is really rising over the fate of Prime Minister Barnier's government, whether France could struggle to pass a budget for next year. We've got the far-right National Rally Party threatening a no-confidence vote to bring down the government if those demands are met. And so there is a lot of concern at the moment, although we did see that sort of rally after the Finance Minister Armand said that he is prepared to make concessions on next year's budget. But, of course, we have seen now months of underperformance there as well. So we'll be continuing to sort of watch that. As in terms of volumes as well, we've seen French bonds seeing their worst weekly outflows in more than 2 years through to Tuesday. So continuing to watch that situation very closely. We do have more ahead on the Asia trade. This is Bloomberg.
Not only real estate, but also other assets may not necessarily have high efficiency, so we will carefully review these areas and decide whether to sell them if necessary or to make good use of them through various financial methods. We will consider on a case-by-case basis what kind of approach is best.
Tokyo Gas President Shinichi Sawayama speaking in Tokyo. This, of course, as we continue to see pressure from activist investor Elliott Management to sell some of those non-core assets. And you're seeing Tokyo Gas right now continuing to gain about 2.5%, a second session of gains, which puts it at the highest level on record in Haidi.
Shery, let's take a look at some of the headlines we're following when it comes to the corporate front. And Saudi-backed Live Golf is said to be weighing a potential deal with Europe's DP World Tour. The talks may see the two competitions merge, creating a shared schedule and allowing golfers to play in both. Live Golf started as a rival to the PGA, luring top players and sparking animosity with the existing tours. Renault is going on a hiring spree in China, the market where it doesn't even sell cars. Sources say the French automaker has hired 200 people in Shanghai, mostly hardware engineers, working on development of its Twingo EV. We're told it plans to hire software engineers as well. More ahead on the Asia trade. This is Bloomberg. Take a look at WTI. We're pretty flat at the moment and kind of along that medium-term trend that we've seen trading within that tight range since about October or so. We are looking like futures looking some downside to the tune of about 3% this week. Of course, we've had the Hezbollah-Israel ceasefire news as well as some of these concerns over what to expect from OPEC+. Let's get some more on the outlook with Mukesh, who's the global head of oil commodity markets at Rystad Energy. And of course, we've been trying to work out this delay by about 4 days. We're expecting the OPEC Plus meeting on Sunday. Does the fact that they've had to delay things suggest that there's not an easy path to consensus at the moment?
Good to be back here. I think you're spot on that there is indeed not an easy path, and a lot has changed in November with the US elections, right? So I guess there is a lot to figuring it out. Plus, there has been, times where there has been hope to bring the barrels back. Now it's a continuous time period of long cuts, right? And there are members who are intending to increase production. One example is Kazakhstan probably wants to touch more than 2 million barrels per day crude production by end of next year or more than that. UAE wants to get the 300 KBD quota it was given for 2025. So there are members wanting to add more, but the market and 2025 fundamentals are not giving any option.
Well, fundamentals can also be wildly differing depending on what sort of fiscal and other policies we get from the incoming Trump administration, right? We had a conversation earlier where the guest was like, look, the Fed can't preempt government policy. OPEC Plus also can't preempt some of the geopolitical developments or the domestic US policies, right? So how difficult is it to navigate that uncertainty?
Well, I would say that some things have become certain, right? Trump has won. That certainty is there. I think I call it Trump 2.0. And China, we are getting more certain about the weakness in China. And I think we look at China from what I call China 1, China 2, China 3. China 1 is domestic growth driven. China 2 was becoming the export factory of the world. And I call China 3 in a very tariff driven world would probably be looking more expansionist. So China will go out in other countries and grow. So I think in those contexts of Trump 2.0, China 3.0, I think OPEC has a tough place to figure out what to do.
When it comes to Trump policies more specifically, we have seen those threats of 25% tariffs on Canadian imports as well. And we know that that would affect energy assets as well. How does that compare to also Trump wanting to increase more American energy production?
That's an excellent question. I think whether it's a negotiating strategy or it's something for real, certainly not having Canadian crudes go into the US markets, Canadian crudes will find way towards the Asian market. So that might put pressure again on OPEC whether to bring the barrels because the buyers are mostly in Asia, number one. Number two, even if Trump wants to help the domestic crude production, we believe it won't be helped much by these protectionist measures. We expect only 500,000 barrels of crude production growth probably next year. And I think the biggest challenge for U.S. producers is it's not the right quality of the oil. It's the light barrels. The world is flooded with light barrels. What the refining system needs is some of the medium sour barrels, which is in OPEC hands. So I would say that it's not just a volume game. The quality considerations will play a big part into it, and what Trump is trying to achieve is tough.
What are we expecting to see in 2025 when it comes to OPEC Plus countries, as you said, that face so many tricky challenges at the moment?
What I would say is that we, at Right Energy, we look at very bottoms-up data, and that data is clearly telling us 2025, if non-OPEC brings barrels, 1.5, 1.7 million barrels per day. If OPEC brings the barrels, another 1.3. So we are looking at near 3 million barrels per day of supply, crude supply, whereas the demand numbers are probably having a consensus around 1 million barrels per day. So I think there is no ambiguity around the glut that's going to come in 2025. With that in mind, we believe that OPEC, as I say, OPEC 4.0 will probably roll the cuts again, at least for the first quarter. And then it depends largely on the sanctions that might come on Iran, that might come on Venezuela, where in world there might be some production going out. Then OPEC might think that they can bring the barrels back. Another point, I think, which often gets less understood is that while OPEC is removing barrels and cutting barrels, they are pumping a lot of products, exports into the market. When you bring products back to the market, it is like giving crude in an alternate form. So I call it OPEC is using a two-pedal theory, managing crude and product exports. I believe they can't do both, pumping products and bring back crude. If they're really serious to bring back crude, they have to cut all the products.
What about the ability to increase shale output and assets, right? Because we know that that's something that has been top of mind for President-elect Trump as well.
Well, I would say, everybody is familiar with the drill, baby drill rhetoric, right? And just recently, one of the senior executives in Exxon was probably hinting that's not going to happen. And I think there are some important geological factors which are at play. There is these companies are consolidated companies, and it's not, I would say, much tighter industry. A second factor is the productivity gains, and those things are also not that supportive. And lastly, as I indicated, the quality of the barrels. Imagine if U.S. shale was the same quality as the OPEC countries, we would be in a very different world, right? So it's the wrong quality of the oil which US is sitting on, plus all the US refining system never was designed for these oils. So it's a huge mismatch. What they found under the ground and what they have, the refining system, is kind of completely out of, and they have done a lot of things. So I would say that both the need at home and the call from outside is not going to be strong. So this won't work, and we expect only 500,000 barrels kind of a growth.
Mukesh, Sahdev, good to have you with us. Senior Vice President and Global Head of Commodity Markets, Oil at Rystad Energies. We continue to watch energy prices right now. That sector, one of the big losers across Asian markets today. You see the Nikkei also down 0.8%, and the ASX 200 being led lower by utilities and financials. When it comes to the Kospi, it's really leading the losses across Asia, down by the most in about 2 weeks already. Every sector is in the red after the first back-to-back rate cuts since the global financial crisis. We'll be watching the Korean won as well at the moment, trading at that 13.94 level. We have more ahead on the Asia trade. This is Bloomberg. We're keeping an eye on Japan's biggest banks. We're now hearing that they're planning to maintain ties to billionaire Gautam Adani despite the U.S. bribery charges surrounding the billionaire. We have heard from sources telling us that Mizuho Financial expects the latest saga surrounding Adani will not actually have a long-lasting impact, and they intend to continue supporting the group. Of course, we have seen other global firms like Barclays reassessing their exposure to the Indian conglomerate. A little bit of a mixed picture in today's trading session as we're seeing broad downside, Haidi, when it comes to Asian equities.
Yeah, and taking a look across what we're looking when it comes to FX as well. Of course, some of that EM pressure coming through. Some of the sort of idiosyncratic stories when it comes to Brazil, for example, some of those tariff concerns still playing out for emerging FX, including the likes of the peso, and also those moves in the yuan are quite interesting as well. Also, still watching to see that Bank of Korea surprise move yesterday and how that's playing out for the won. But let's get more when it comes to what we're watching in these markets. At Bloomberg's Markets Lab, Asia team leader Garfield Reynolds joins us now. So what's top of mind for you today?
Well, the yen, is top of mind again. It's been showing plenty of strength lately, and the Tokyo CPI figures today were pretty strong to the upside, which highlights the concern going into the BOJ meeting next month that they will either actually hike rates, or if they don't hike rates, they're going to lay out a fairly comprehensive plan to hike rates early in the new year, probably more than once. And I mean, the yen's strength also ties into and underscores the difficulties facing emerging market currencies that you were mentioning, from the concerns about Trump tariffs and US dollar strength in general. Those social posts at the beginning of this week, when Trump highlighted the tariff plans, set off plenty of weakness in currencies, except for the yen, and that's partly because of that divergence in the policy outlook, but also because traders are going back to the first Trump presidency and taking a look at what happened then. And it's like, what do you know? The yen did just fine at a time when most other currencies fell against the dollar. So the instinct there is to go into the yen, and there are those fundamentals that support it, both what's going on with the interest rate outlook and, Japan still continues to be a current account surplus country. That does ultimately matter from the point of view of making the currency get into and out of without causing major movements.
On the dollar side, are there any persuasive sort of reasons to think that Trump 2.0, automatically stronger and persistently stronger dollar, is just a done deal?
Well, it's the persistent strength that you have to wonder about. 'Cause after all, the Mexican peso, for example, has done very, very badly in the first little while, but then it came back when he spoke with Schauenbaum, and also last time round, the Mexican peso came back because ultimately they were able to work, with Trump and with the Trump presidency. And there's also, the question of what goes on with the U.S. economy. Does it stay resilient? At the moment, we've got traders pricing for a pretty slow pace of Fed rate cuts, a pace that seems appropriate considering where the economy is. But it's hard to see them taking too many more rate cuts off the table. So the bias is going to be in the coming year, unless Trump's policies do cause a re-acceleration of inflation, and that's extremely unclear because we don't really know what the policies are going to be and how effectively they're going to be enacted. So with the risk now starting to skew towards a faster pace of Fed easing than is currently priced, that signals, that the US dollar has the potential to come lower next year. There's also the question of, again, there's been lots of fears that the yuan would weaken, but will it weaken in the new year?
But how much of U.S. dollar strength is also to do with what's on the other side of the trade? Because we have seen this incredible pressure on the euro. And not surprising because we're also pricing in more rate cuts to come from the ECB. And now the latest from all the French assets really being pressured on their budget issues.
Yeah, France, continues to be the gift that goes on giving a fairly sour bunch of gifts when it comes to European assets. Not many good solutions there. That's going to keep French bonds under pressure. Yields briefly on French debt matched those on Greece's, which was not something anybody had on their bingo card, I think, for this year. So that's a major concern. That's the uncertainty angle that's hurting both the euro and European stocks. There's also the broader economic angle where German inflation, came in a little bit weaker than had been feared. So that puts rate cuts back on the table. The euro, to some extent, it's surprising that it's hanging on where it is now, although it has been the worst performer since Trump won election, which again underscores the concerns there for the euro that are being driven by the Trump angle, as well as by French political concerns, German economic concerns. You also have to wonder whether there's any impact from some of the concerns surrounding Russia. The Russian ruble is crashing, and you've got a heightening of tensions there. That's got to add to some level of uncertainty about European assets. So the euro looks unlikely to be able to bounce back much at the current time. Again, in the new year, if you do get a situation where that rates path starts to come back a little bit more in line with what the Fed is going to end up doing, then you might get the euro bouncing back. But that's something for the new year rather than through the end of 2024, it's looking like.
Bloomberg Markets Live Asia team leader Garfield Reynolds there with, of course, a look broadly at the markets as we continue to watch also for earnings later today coming from Chinese consumer giant Meituan on their third quarter results. Analysts expecting earnings growth to have accelerated on the back of a gradual recovery in travel, dining, and online commerce. Bloomberg Intelligence senior analyst Catherine Lim joins us now for our preview. So how encouraging could these numbers be, given that we're still struggling with a downturn in the Chinese economy more broadly?
Right. I think the expectations really is that the consumption or the basic consumption side of things, notably consumer services such as the deliveries, the travel side of things, it had actually held up well over the July, August, September quarter, and that's what Meituan will be releasing. Again, more importantly, it is the outlook into this current quarter, the fourth quarter, after Beijing announce their stimulus. I think the expectations and the hopes is that, there will be incremental upticks in the spending. So we'll have to see what comes through from the company later this evening.
What are going to be some of the challenges, given that we've seen, for a number of these domestically oriented companies, that sustained weakness across households, across, the property sector have continued to weigh?
Right. Relative to, I would say, e-commerce, I think the entire delivery side of things that Meituan dominate, you don't face as intense competition, even though you're still seeing some of the nibbling of this market share coming from Douyin as well as Alibaba's Ele.me. But again, it is less intense, and Meituan clearly has a advantage in terms of size as well as early mover in some of the bigger tier markets. I think really the challenge ahead is, will the growth inevitably slow as the size of the company, their business itself gets bigger? That's on China. And let us not forget that Meituan is also looking to actually dabble outside of China. And we'll see whether there are more updates coming through for their ventures into Middle East.
Bloomberg Intelligence Senior Analyst for Consumer and Technology in Asia, Catherine Lim, there with a preview, of course, of that third quarter results from Meituan. You can follow more on this story and all of the day's trading on our Markets Live blog. That's on the Bloomberg at MLIV Go. You can get a market rundown in one click, and there's also commentary and analysis from Bloomberg's expert editors. Right. Asian markets right now trading a little bit mixed, a lot of downside pressure at the moment. We'll be back after the break. This is Bloomberg. We take you live to Manila. We're inside the National Bureau of Investigation. The Philippine Vice President Sara Duterte has been ordered to appear before this agency. Philippine authorities handed her a subpoena earlier this week, inviting her to answer questions after she publicly said that she had arranged for President Ferdinand Marcos Jr., his wife and his cousin, and also the Speaker of the House of Representatives to be assassinated if she were fatally attacked herself. Bloomberg Opinion managing editor Ruth Pollard joins us now to discuss this very dramatic feud. I mean, political violence is nothing new in the Philippines, but this seems to have escalated to different levels now.
It really has. And while political violence has been very common at the local level in the Philippines, it's really rare to see it at a national level. And coming straight from the lips of the Vice President, of course, and her father. So I think this has escalated in a way that none of us expected. This political marriage of convenience that was forged during the 2022 election campaign, nobody expected it to last, but nobody expected it to explode like this.
What does that mean for the Philippines?
So the Philippines under President Marcos is in a pretty good place, both domestically and foreign policy-wise. He's got the nation back on track in terms of its relations with the US, which is a key treaty ally. And he's also overseen a policy of pushing back quite strongly against China over its incursions in the South China Sea. So if you were to rate his performance, he's been doing quite well. And I think that is one of the reasons that the Dutertes are pushing back so hard against the Marcos family.
Where will this potentially go next, Rad? What are we watching at this point?
Well, we're watching what will happen with the National Investigation Bureau and whether Sarah will indeed present to be questioned and to make a statement over her threats to President Marcos. And we're also watching what will happen, for example, with the International Criminal Court, which is investigating her father over his so-called national war on drugs, which cost the lives of thousands of people and which has also been a real trigger for the Duterte family. I think they feel under threat on many levels.
These are two very famous and at the same time infamous families, right? How did the marriage of convenience happen and what led to this incredible escalation?
So the marriage of convenience happened because Sara Duterte herself, I think, had ambitions for the presidency that President Marcos Jr. Eventually won. And so, as often happens in the Philippines, two quite opposing forces teamed up and ultimately won that election in a landslide. Since then, Sara has been overseeing the education department, for example, and there are allegations which she vehemently denies that she misused funds as part of her work there, which is also the subject of another inquiry by the Parliament. And so quite quickly these claims escalated and it became untenable, I think, for her to continue to work under the Marcos regime.
Bloomberg Opinion Managing Editor Ruth Pollard there on a truly extraordinary domestic political situation unfolding in the Philippines at the moment. But in the meantime, as we look towards the start of trading in Greater China, this is a picture. US futures actually seeing a little bit of upside there. Of course, it is Thanksgiving week, so very holiday-thinned sort of volumes that we're talking about at the moment. But here in Asia, we are seeing some broad weakness really across the board when it comes to equities in Japan and Australia. You're looking at TAIEX futures looking to reflect some of that weakness going into the start of the session. But the last traded FTSE A50 China futures, a little bit of a glimmer of hope despite that retreat that we've seen from Chinese equities.